Well, good morning or good afternoon to everyone, depending on what part of the country you are calling in from. My name is Ginger Bell, and I would like to welcome you to the Finance of America Fix and Flip webinar. And today we're going to be going through the details of the Fix and Flip program that is available to you through Finance of America Wholesale. So before we get started today, I want to take care of a couple of housekeeping issues. First of all, you'll be able to see my screen, and I will be forwarding the slides. There are two different ways that you can listen to this webinar. You can either listen through your computer and just listen that way, or you can call in and listen on your phone. So either way works, and the instructions are there. If you're already hearing me say this, you've already figured it out. But I just like to let people know in case they are having any difficulties being able to dial in. The next thing is, if you do have questions, and I'm sure you'll have many about the program today, we're going to do a Q&A at the end of the session. But if you have a question that pops up while John is going through the information, feel free to type it in either the chat box or in the Q&A box. Both of those get to me, and both of those I will see, and then we'll do a Q&A section at the end. And, probably a lot of your questions might be answered as we go through the information today. But obviously, if you do have questions, we want to make sure that you can ask those there. And let's go ahead and check and make sure that you know how to ask questions and that you all can hear me. So if you can just type in hello in your Q&A box or your chat box, let me know what part of the country you're calling in from. I always love to hear how the weather is. I am in the Pacific Northwest today, and yeah, it's rainy. It's true. It's rainy here. But I'm going to be going to Denver and Dallas in the next couple weeks, so hopefully the weather will be nice there. Okay, so you all are weighing in. Hello, hello, hello to all of you. And so we'll go ahead and get started. I want to share with you, we've got a couple of webinars coming up. You know, we do a lot of webinars at Finance of America. And so our webinar next week we are doing is on the renovation loan products, the 203K limited, the standard, and as well as the home style. And so we're going to do an open mic, what I call open mic, which is an open session for Q&A. And we have a lot of questions that come in, that come through our webinar. So we're taking those top questions, we'll be answering those, and then it's an opportunity for you to ask questions as well. Hello, Annie from Orange City and from Montana. I love Montana. My brother in Missoula will be going through Montana in a couple weeks. So I want to also let you know that we do have a handout of this presentation. I'm going to actually post it in your chat box. It's on that little link right there. So if you want to pick that up, you can do that. I will also be sending out, I'm recording this webinar, and then I will send a follow-up link tomorrow by email, and I'll include a copy of the presentation and then also a copy of the recording. So if there's somebody in your office that didn't have an opportunity to be able to hop on this webinar and you want to share that with them, you can. Maybe even share it with one of your realtor partners. Say, hey, I want you to come and listen to this. This is a great product that we have available. And so as I'm introducing to you your presenters, my name is Ginger Bell. I'm an education specialist. Finance of America is one of my fantastic clients that I have an opportunity to work with and provide monthly webinars and different training in the industry. And then with me today, I have John Cate, and John is a field market specialist for Finance of America. And I'm going to let John introduce himself as far as his experience. And while he's doing that, I'm going to actually launch a poll that you're going to see on your screen. And I just want to get an idea how many of you are currently working with real estate agents, realtors who have investors. So investors that are buying investment properties like the fix and flip, or even building a portfolio of investment properties. So take a few minutes, answer that. And John, I'd like to welcome you to our webinar today. Thanks so much for joining us. And tell me a little bit about your background and what you do with Finance of America as a field market specialist.
Yes, hi Ginger. Thank you for the introduction. Again, my name is John Cate. I'm a field market specialist with Finance of America Commercial. I've been with Finance of America Commercial a little over 2.5 years now. I've been in the commercial side, or the fix and flip business for a little more than 4 years now. My background is residential, conventional government originations going back to, 25 years now. I do live in Tampa, Florida, where it's sunny and 75 right now.
I bet.
And soon to be a muggy 95
Oh,
and nasty for the next 4 or 5 months coming in the summertime, but Christmas or wintertime is over in Florida. But today is a nice day.
well, good.
Yeah, back to what I do at Finance of America Commercial, a little bit, I'm not a narcissist, but a little bit more about me. I'm an active fix and flipper here in Florida. I do have an active real estate license, which helps me with acquisitions and sales of fix and flip. So I kind of have that background I'm coming from your background as loan originators and brokers. I understand that business. I understand working with realtors, and I understand working with fix and flip investors. So my job as a field market specialist is to train mortgage brokers how to position and sell our fix and flip and rental property products to their investors. And I'll tell you, I've got a lot of respect for everybody on this phone call right now, because it's not easy to try to learn something new.
Right.
But I bet there's a lot of people on this call that are thinking, you know what, business seems to be dropping off a little bit. I need to probably get into a new type of market, which is working with real estate investors. And if you want to learn that business, I'm here to train you on how to learn that business. And
Excellent.
you don't have to know everything right now. What's important is I'm going to give you a high-level overview and maybe get into the weeds a little bit on this presentation on how the products work and how to position the products. But what I want you to do is take a leap of faith and go out in the marketplace and start talking up these products. Tell your referral sources, your builders, your realtors, your financial planners that you work with real estate investors, and ask them for their business, for their referrals, that you can work with them. And you're not going to know everything up front. They're going to have questions that you might need to get with me on, or look up the answers later and get back to them. But if you don't ask for the business, you don't get the business. So that's just a quick introduction, and we'll get into more of the presentation later.
Excellent. Thank you. And being able to really use that expertise to go out and talk to realtors about something different is so important right now. So I'm going to end our polling, and I'm going to actually share the results. And John, we have a very high percentage of our audience. 89% of our audience are currently working with realtors who have investors. So that is absolutely fantastic. And I think you're going to be excited about the information that John has to share today. So with that, let's go ahead and get started. John?
Yeah, so this first slide is really, when you all think of Fannie fallout, we see a lot of Fannie Freddie fallout with working with real estate investors. So we have a better way with Finance of America Commercial. We're going to be much more flexible in the underwriting side. We don't have all the limitations of conventional financing for permanent financing for investors. So the Fannie fallout comes from when you're trying to get an investor for a purchase transaction or a cash out refi, and they don't meet Fannie's guides. Well, they will meet our guides if typically if they don't. So next. All right. So there's three distinct products that we're going to talk about today. The fix and flip and the new construction. I like to wrap those together because that's going to be our line of credit product, which I will get into shortly. But the line of credit allows an investor to tap into their approved line of credit for traditional fix and flipping, which is acquire an existing property so that we can do the financing of the acquisition and the financing of the rehab. And they can use that same line of credit product to tap into for ground up construction. If they want to buy if they want to buy a piece of land and build ground up and flip it or turn it into a rental property, they can tap into the line of credit with new construction. And then finally, the last part of my presentation is going to be about rental properties. This is for an investor that wants to acquire rent-ready properties, or they want to cash out a rental property that's currently leased up and they want to pull cash out. And these are 30-year fixed rate products. So that's typically what I mentioned earlier with the Fannie fallout is going to be for the rental property financing. Most banks don't do short-term money for fix and flip, but we do. So here are the highlights. No personal income required. Remember the old stated income days? Well, we don't even ask them to state income. It's all about the product is all about the project, which is the property asset-based lending. We lend to LLCs, corporations, S corps. So no more of this. Hey, what if the investor wants to take title in an LLC, or they have a refinance and they want to refinance, but they don't want to go through the hoops of deeding out into their own personal name and back into the LLC? No problem. 99% of my borrowers take title in an LLC or a corporation. Our line of credit product goes up to a project loan of $2.5 million. So we'll set up a $10 million line of credit for our fix and flip investors, but they can tap into that line of credit for up to $2.5 million project loans. So anything near the water like we are here in Florida, or any expensive real estate project, $2.5 million, which is a nice cap. And we offer renovation construction exposure limits, also known as the line of credit. So when I say line of credit, I'm also simultaneously saying exposure limit. It's basically the amount of financing that we approve the borrower for that they can tap into. And when we set up the line of credit, the beauty of the line of credit for the fix and flip investor is we only qualify them once a year. So once they're qualified for the line of credit, we're not asking them to requalify every time they pull down a project loan. We're just going to qualify the project itself. All right, Ginger. So go ahead and click another button there, Ginger, and just go ahead and load the whole slide. There you go. So I want to talk to the different spectrums of financing in our space right now. We have traditional financing, which you're familiar with, on the rental property financing, which is conventional. We've already talked at some of the limitations. The borrower has to supply their tax returns and show sufficient net income to qualify for these investment property loans. Not all of them do, because their accountants are doing a good job writing off the majority of their income, and they don't have enough net income to qualify. So there's a lot of fallout there with the tax returns. Most of my investors don't qualify for conventional because their tax returns don't show enough net income. They either have too many mortgages, so they're tapped out on their conventional financing because they have too many investor mortgages, or they want to take title in an LLC. Various different reasons they don't qualify. That's on the traditional financing. Now, what about fix and flip investors? Where do fix and flip investors get financing? Well, if you remember back in the crash, all the way up until about 2012, 2013, there was no financing for fix and flip investors. And we have a tremendous amount of investors out there that took down projects in cash. And they are cash poor and equity rich right now. So those are the investors that you as brokers need to go after, because they would love to pull money out of their investment properties right now and invest in more property, or fix up the properties they have right now that have been that have been rental properties for several years. But all cash is the other spectrum. And the problem with all cash right now when they're going after new transactions, it's very common. If an investor has $200,000 to let's say play with for a fix and flip investment, how many deals can they do a year? Typically, it's only one or two, because they can't take on a new opportunity until they flip the property that all their cash is tied up in. So if we can put leverage in place, these investors can take down 4 or 5 or 6 projects at a time, with using our fix and flip line of credit products. So that's the benefit and really the value add of using leverage. And then let's talk about hard money. There's a lot of investors out there and a lot of brokers right now referring their clients to hard money lenders. The problem with hard money? Simple. It's expensive. 12%, 3 or 4 points. It really eats into the profitability and the margins of the investors. And some of them will shy away from doing fix and flip activity because they don't want to pay the hard money fees. That's why you need to introduce them to Finance of America Commercial. We are right in the middle of the spectrum. So we're going after investors that have good credit, money in the bank, good track record experience of flipping properties and owning rentals. And if they do, we're giving them much better pricing than hard money. So my best price is 7%. Typically, most of my clients, my investors, are in the 8% range, which is they have experience, money in the bank, and liquidity. What's it take to get 6.99? A lot of experience and a lot of money in the bank. $500,000 in the bank, 26 flips in the last 2 years, or a combination of flips and rental properties totaling 26, but that's my best rate, so that is possible. And if you work with some of these investors, we will improve the rate as they continue to gain experience and gain liquidity, so that's always an option and a nice selling feature. They might start out at 8% today, but at the end of the year, when we refresh their line of credit, their pricing can get much better. Next slide, Ginger. Let's jump into the fix and flip. Next slide. So here, and I like the fact that a lot of you are working with real estate investors right now, or working with realtors that work with real estate investors. One thing I need to say about that, and I should have said it earlier, the benefit to you as a mortgage broker working with real estate investors is it's the gift that keeps on giving. So once you have a relationship established with several investors, they're going to be tapping you for, and Finance of America hopefully, for multiple purchase transactions a year. And then you can actually feed that back to your realtors for helping, getting those realtors to help buy those houses. And the realtors get the flip side, which they get the listing on the flip side. So again, benefit to working with investors for you and your realtors, multiple business from the same clients. All right. Here is a snapshot of what your sales pitch needs to be as a mortgage broker when you're talking to investors. Rates start at 7%. We'll lend 90% of purchase price, 90% of rehab costs, as long as those two loan sizes together are less than 75% of the after repaired value, loan to value. So when I talk leverage points, this is what I'm talking about. This borrower would have 90, 90, 75. So they come to the table on a purchase transaction with a fix and flip with 10% down payment. We will hold back 90% of their budget, and that loan size together, which is 90% of acquisition, 90% of rehab, has to be less than 75% of the after repaired value, which is given to us by the appraiser after reviewing the customer's budget and looking at all the improvements that the investor plans to make. So the appraiser is going to give us two values, right? They're going to give us as is value today, which should be purchase price or higher. And they're also going to look for comps that have similar improvements to what the borrower plans to make. And they're going to give us after repaired value. So those are the standard leverage points. If you have an investor that that might have just one flip in the last year, that leverage point might be 90, 90, 70, which means we'll haircut the LTV a little bit for somebody that has less than 3 flips or rental properties currently. We'll go up to exposure limits of $10 million. So again, just a high-level snapshot of the type of financing, because your investors will say, how much will you lend? How much down payment do I have to make? How much of the repair cost do I have to make versus what I can finance? All right, next slide. Okay, here's how we price, and this is very important. I mentioned earlier, not everyone gets 6.99 with interest only. It depends on their experience level as an investor, and we define that as how many flips have you sold in your name or your entity's name in the last 2 years, and how many rental properties do you own today. That's experience. That heavily weights the interest rate. And my model, my pricing model, will run the interest rate for you. It's very simple. You can run a quote on my model within 3 or 4 minutes of inputting this information. It'll tell you what interest rate and leverage points the borrower qualifies for. Number 2, liquidity. Liquidity drives exposure limit. So what we do is take the ending balance in the most recent bank statements that the borrower has, multiply it times 5, and that's the exposure limit. So if a borrower has $200,000 in the bank times 5, that's $1 million line of credit that they can tap into for multiple project loans. So if a borrower had $1 million line of credit, theoretically they could tap into 4 different project loans of $250,000 each and work multiple projects off of that line of credit. Liquidity drives that, and liquidity can also drive interest rate. We can give pricing improvements based on thresholds of liquidity. $200,000 in the bank gets a better rate than $100,000 in the bank. $500,000 in the bank gets a better rate than $250,000 in the bank, and so on. Credit score down to 620. We take a mid-score, and the good news is if we have multiple borrowers, typically we'll have partnerships. We'll have an investor that partners up with another investor. We'll run credit on both of them. We will price based on the highest of the two mid-scores, not the lowest of the two mid-scores, so that can help. We will go down to 620, and that's a hard stop. A 620 borrower is going to have a higher interest rate and lower leverage point than a 700 plus borrower, so we do risk-based price on credit score. And finally, net worth. We require the borrower to complete a personal financial statement and state their net worth. They just list total assets, their total liabilities, and assets minus liabilities is net worth. Net worth must exceed stated at least 30% of exposure limit. So if a borrower needs $1 million line of credit or qualifies for $1 million line of credit, their personal financial statement net worth must have a $300,000 or higher net worth. That's it. Next, Ginger. All right, this is small. I just threw this in here because if you're out in the field and you want to pre-qualify somebody and you just need the general information to run my term sheet, this is all you need to have the borrower fill out. You can email this fillable form to the borrower because, again, their question is, what rate do I qualify for on your fix and flip? What are my leverage points? If they fill out this form, then you have all the information you need to plug it into my model and give them a term sheet. Next slide. Okay, so let's get into a little bit more. You guys are mortgage brokers, so some of you are going, okay, I want more detail. What are the underwriting? What are the guidelines? What are some of the underwriting qualifications? Let's get into that right now. To set up a line of credit, and this is for my fix and flip exposure limit line of credit, minimum requirements: experience of 1 flip in the last 2 years or 1 rental property owned today. If they don't have that, they don't qualify for a line of credit. We do have a single fix and flip, which is for investors that just watched HDTV last night. They've never done it before, but they think they can be a flipper and they want to do it. That's a single fix and flip. We're not going to talk about that on this because most of my brokers here are going to be working with experienced investors, and that's really what's in our wheelhouse. Individual loan size, we will go down to $50,000. So what I mean by this is they can actually take down a $30,000 purchase price and put $50,000 into it, and as long as the acquisition loan plus the rehab loan exceeds $50,000, they qualify for that. That project can qualify to tap into the line of credit. And as I said, the minimum or the maximum exposure for a loan, project loan, is $2.5 million. Exposure limit: we will not set up a line of credit with less than $250,000 line. And when we back into the math, that requires $50,000 in the bank. 50,000 times 5 is a $250 minimum, up to $10 million. If a borrower has less than $50,000 in the bank, they could qualify for the single fix and flip, and that's risk-based priced. Next, loan to value. We will, I'm sorry, keep there. 75% of ARV. So we will never lend more than 75% of the after repaired value of the property. Couple more, Ginger. One more. There we go. Let's stay there. Acquisition financing, 10% down payment, we can lend 90% of purchase price. Rehab financing, the max we can lend is 90% of their budget. Their budget is an itemization of the work they plan to do, where they itemize out kitchen remodel, $15,000, new roof, $10,000, carpet paint, $5,000. That's the budget. That is sent to the appraiser, and that's how the appraiser will generate after repaired value. Interest. Interest accrues on the full loan size, which is acquisition loan plus rehab loan. The benefit to you as brokers, you are paid at closing on full loan size, which is acquisition loan plus rehab loan. There is no interest or fees paid on the line of credit exposure limit. So if I set up $1 million line of credit, you nor I are paid. Neither of us get paid until they tap into the line of credit for a project loan and it closes. But you're paid on full loan size. Properties, let's talk about properties. Finance of America has commercial in the name, but we do not lend on commercial zone properties. This is residential fix and flip and rental property financing. Single family all the way up to 20 unit apartment buildings. So we are capped out at 20 units per parcel, and we do not lend on office buildings or industrial parks or strip malls or anything that people work in or eat in. We're looking for properties that human beings live in and occupy as an investor, or as like tenant occupied. I am never going to make a loan to someone that is going to occupy the subject property. So no second homes and no primary residence. And our documents, our closing documents, are very specific about that. That the borrower never intends to occupy this property. And again, the benefit is we're private money, so we don't have to go through TRID and Dodd-Frank and quality mortgage and all the other limitations that those products require. Minimum interest, we set these up for 12 months interest only, and the minimum interest period is 90 days. So the borrower will pay at least 3 months of interest. So anytime they flip the property after 3 months of closing the loan, of course, there's no prepayment penalty, but they will have 3 months interest. Credit score minimum is 620, and valuation. We require a full interior, exterior inspection of the property. There is one there's one nuance to this. If a borrower wants to take down a project maybe at auction, and we will not be able to get interior access, we will do those, but we will haircut the exposure limit down to 80% of acquisition. And then once they own the property, we'll verify with an interior inspection. So just remember, an interior inspection is required, but if you have those little situations where there's no interior access available prior to closing, we can make that work with a reduced exposure of 80% instead of 90% of acquisition. All right, next. All right, I'm a visual person. Go ahead and load the whole page. One more. There we go. So I like to see these visuals because a lot of you are thinking, well, how do I want to see the numbers. I want to see how this all works. This might be a little bit different than what you're used to. So let's put the numbers in play. And let's say we have a typical scenario of a $100,000 purchase price, and the investor is going to rehab $50,000. It's going to cost a rehab. And they believe that the after repaired value would be $200,000. This is a typical margin, $50,000 margin. So let's say the investor leverage points, as I call them, are 90, 90, 75. How's the loan work out? Well, at the closing table, the borrower is going to make a $10,000 down payment. So we'll lend $90,000 on the acquisition. We will hold back 90% of the budget. So we're going to hold back $45,000, and we total that up. 90,000 acquisition loan plus 45,000 budget loan is 135. Now remember, you're paid on the 135. Interest accrues on the 135. Now we have to do our checks and balances, which is our LTV. Remember, we're never going to lend more than 75% LTV. So 75% of the 200 after repaired value is 150. So as long as my 90/90 is less than 75, then they get maximum leverage. And in this case, they do, because 90% and 90% is 135, and that is less than 150. Therefore, we will fund a total loan size of 135. That's how you do the leverage example of a purchase transaction. And if it was a refi, it's important to note here, we will do a refinance transaction at the exact same terms and pricing as if it were a purchase. Here's an example. Let's say the borrower takes down a project, you know how it is, cash is king, and the seller is like, I don't want to deal with, waiting 3 weeks, 2 or 3 weeks to get the loan closed. I want to close tomorrow. And if that's the case, I will tell my investor to take it down in cash, and we'll cash them back out. So in a refinance transaction, we will lend 90% of what they paid for the property and put that right back in their pocket as cash out. And then we will hold back the 90% of rehab, just as we would with the purchase. Remember that. Investors that want to close fast, if they can take it down in cash, get that money together, we will put that money back in their pocket within 2 to 3 weeks. And that's what it takes to close a project deal off an approved line of credit. Give us 2 to 3 weeks. We need an appraisal, a construction report, a title policy, and an insurance policy, a couple of days to underwrite, a couple of days to generate documents, and that usually takes 2 to 3 weeks. So next slide. All right, let's go over some frequently asked questions, and I'm going to run through this quickly because you're going to be able to see these questions. Ginger is going to make this deck available to you, but these are common questions that the investors are going to have. What are the rates? Well, just tell them the rates range from 6.99 to 9.99, depending on their experience, credit score, and liquidity. What's the term? We set it up for 12 months interest only, and there's a 3-month interest minimum period. We can do longer terms than 12 months. Actually, we can do an extension, 3 months extension if they run out of time, but there is a cost to that extension. It's a 1-point extension fee. But that question comes up. What if I'm in Michigan and it's wintertime and I can't get the house completed and I need more time? We'll give them that flexibility, but there is a fee. We have to turn our money within 12 months. And if we can't turn it in 12 months, we have to pass on that fee to the investor. What types of properties? Single family, condos, duplexes, triplexes, all the way up to 20-unit apartment buildings. How does the loan to value and the loan to cost work? And I kind of went over that with my scenario. We'll lend 90% of purchase price, 90% of budget, that's cost, that's LTC, as long as that loan size is less than 75% LTV of the after repaired value. So that's the difference between cost and value. Do we need access to the interior of the property? Generally speaking, you say yes. But in that strange nuance that they can't have access, we can do that at reduced leverage. What are the advantages of the line of credit versus the single fix and flip? Well, speed. The beauty of the line of credit is we qualify the borrower one time a year, and once the borrower is qualified for the line of credit, we're done with them. They don't have to, we don't pull credit on them again, ask to see bank statements, ask them to provide any more borrower documentation. It's all on the property. So that's the benefit of the line of credit. At the bottom, it looks like you can barely see it, or I can see it. Do I need to use a general contractor? The answer is you do not need a GC on traditional fix and flip rehab work. But if we're doing ground up construction, the answer is yes. And we'll get into ground up construction after these 2 slides. When can I request an increase in the line of credit? So you're going to have investors that are going to say, well, I have $1 million line of credit and I've already used half of it, and I have more money in the bank now. I want you to revise and increase my line of credit. We will do that. We either wait a year, which is customary to refresh the line of credit after a year, or if they used half of the line of credit and they season the line of credit at least 3 months, we can refresh the line of credit midstream. And we'll just ask for recent bank statements to verify the liquidity. And we're all about trying to raise the line of credit, right? So if we have an investor that's used half of it and they're coming back to us saying, I need a bigger line, we want to try to make that work. So we'll refresh it with under those parameters. How do the points work? The origination fee, FACO always charges a 1-point origination fee. And we charge that on the full loan size, which is acquisition loan plus rehab loan together. You as brokers are going to charge also an origination fee. It can be all the way up to 2 points. If you charge 2 points, then we're going to charge the borrower 3, and that's 1 to us and 2 to you. So it'll show as lender paid comp, but it's based on borrower paid origination fee. Typically, the majority of my brokers that are doing high volume with this product are charging a 1-point origination fee. So FACO is charging at the closing table 2, keeping 1, paying the broker 1. Although that does not sound like much to you, these brokers are doing multiple transactions a year with these investors, so they can afford to get skinny on the origination fee because they're getting lots of origination throughout the course of the year. And once the line of credit is approved, you as brokers do very little work to put the projects in. All you need to do is upload a purchase contract and a scope of work budget, collect a credit card fee for the appraisal and construction report, hit the send button, and my processor does all the work. So your job is to find as many investors as possible, get them approved for the line of credit, and then just sit back and wait for them to give you project loans, upload the project within 5 minutes, click the button, and we do all the rest, and you get paid when the loans close. All right, that's how the origination fee works. So hopefully a little background on how you price. Some brokers are charging 2 points, but it's a very competitive field. And if the investor feels that it's too expensive to use a line of credit, they're not going to use it as often. Okay, if I want to do a rental loan and then fix it and flip it in a rental loan, you can use the same entity. So if an investor takes title as ABC fix and flip on the line of credit, they can also refinance into permanent financing on the rental property loan and keep the same LLC. In other words, you don't need multiple LLCs for multiple products. It's more efficient this way. How is my line of credit determined? Very simple formula, 5 times your liquid assets. Take the ending balance in the most recent statements, add them up together, multiply times 5, and that's your line of credit exposure limit. We do allow 70% of retirement accounts. So add up your 401ks and IRAs and annuities, haircut them by 30%, and add that to your liquidity figure. Is there a minimum usage requirement on the line of credit or penalties? No, there's not. We do charge a one-time non-recurring application fee to set up the line of credit, $750. If they never use the line of credit, we all did a lot of work for nothing, none of us get paid, and the borrower just is out their $750. Other than that, there's no other fees associated with the line of credit or penalties for non-use. Next slide. All right, so we're done with those. We are going to jump into new construction, and everything I told you about fix and flip line of credit is going to stay intact on the new construction. There's only one thing that changes on the new construction that we need to learn or be aware about, and that is we have a lot, L-O-T, we have land. So how do we address the value of the land? Here's how we plug it in. We'll lend 75% of the value of the land. So, and that's if it's permitted. If it's not permitted, and you'll see this in our guides later, we will lend 60% of the land value, hold back 15%, and once the investor provides us permits to build, we will wire him the money for the 15%. So 75% leverage on land value. And then again, 90% of hard cost to build, and 75% loan to value on the after completed value of the property is always in place. Land, we are not a bare land lender. So if you have an investor that says, yeah, I want to buy a 5-acre tract and it's all scrub right now, and I'm going to do some horizontal development, and I'm going to parcel it all off, and that's too early for us. We need the land to be entitled right now. It needs to be ready to build. It has to have power and utilities run to it, and then we're ready to go. Our loan documents will say when we fund a loan on the land loan that construction must commence within 90 days. So that's an example. We need them to start breaking ground within 3 months of us making the land loan. We don't want to sit on vacant land. All right, next. All right, so I'm going to jump right into the just the differences in the new construction. Let's start with program summary. The new construction program is for developers that are doing 1 to 5 properties at a time. If they want to develop a large subdivision and they want to build 10 properties at the same time, which is actually unusual, we don't do that. We're going to cap them at 5. And typically there's not enough tradesmen in place to work on more than 5 properties at the same time in the same subdivision. So not much of a pushback on that guideline, but just remember, we'll do up to 5 at a time in the same subdivision. Construction must begin within 90 days, and the lot has to be in build-ready condition. All right. Minimum experience is the same as a line of credit, 1 flip or 1 build or 1 rental property currently owned. Now here's the difference in individual loan size. We're going to cap the minimum loan size to, or the minimum is $150,000. So remember before the traditional fix and flip was $50,000. We are not going to set up and fund a new construction land loan for less than $150,000. And we still have the 2.5 mil cap. Everything else is going to be the same until we jump down to lot. Here's where we disclose 60% if no permits are in place. And here's an example of that. If an investor wants to buy a vacant lot, typically permits are not in place. The seller hasn't gotten permits to build yet, and our investor might want to build something different. So it will typically require a 40% down payment for the purchase of the lot. We will hold back 15%, and then once permits are in place, that means the investor is ready to go vertical on it, and then we will wire him the money for the other 15%. So 75% leverage with permits in hand. Nothing else is different. Everything else is the same. So let's go ahead and go to an example. Next slide. So here's our visual. There we go. Let's say the land value is $100,000, and this is a purchase transaction. No, let's call it a refinance transaction, because typically with refinance transactions, I recommend to my investor, go ahead and get permits in place. Then I can immediately cash you out at 75% of the value of the land. So that's the example that we're going to use right here. So the land is worth $100,000, and the cost to build is $200,000, and they believe that the property will be worth and they'll be able to sell it for $350,000. So we're going to lend 75% of the value of the land. We'll hold back 90% of the hard cost to build, and hope that in this case that loan size is less than 75% of the $350,000. So here are the numbers. At the closing table, we will cash out. Our initial advance is going to be $75,000. They can use that $75,000 to pay their closing costs, roll it in. So the cash out proceeds will be $75,000 minus closing costs, and they walk away with whatever that figure is, $65,000, $70,000. And then we're simultaneously going to hold back $180,000, which is 90% of their budget. They cannot have access to those holdback funds until work is completed and inspected. So that's called a draw process, and I'll walk through that real quick. It's very efficient, very simple. We have a dedicated draw team in our regional office in Chicago. All they do is handle our draw requests for our investors. Draw requests are a hot button for fix and flip investors or builders. They need access to these funds very quickly upon work being completed, because they need to pay their tradesmen. Our draw process averages 3 to 5 business days. So once a draw is requested, let's say in this case, typically new construction is 4 draws. 25% of the total work is completed. They'll send an email to my draw department. My draw department will request the inspection from Granite Construction Inspection Services, our vendor. They'll make contact with the investor. They'll get in their truck, drive out, and view the job site, confirm the work that has been completed. Let's say it's 25% of total budget. And they'll write a completion report, and then within 24 hours, we're wiring the investor directly 25% of their budget. So if they had $200,000 in a budget, $50,000 wire is going to them so they can pay their tradesmen. And most tradespeople are okay with getting paid within 3 to 5 days of completing work, especially if they're getting repeat business, recurring business from these investors. All right. Max loan amount in this case is $255,000 because the numbers work. 75% of after completed value is $262,500. As long as the $255,000 is less than the $262,000, then maximum leverage is in place, and in this case it does. Now what if the investor's after repaired value or after completed value comes in less and the loan size on cost is constrained? That's not a problem necessarily. It just means they're overbuilding or over improving for the neighborhood. And it means we don't have enough equity to lend 90% of their budget. Maybe there's only enough to lend 85% of their budget or 80% of their budget. They can still take down the project. They'll just have to use a little bit more of their cash for the rehab, or in this case, the cost to build, because there's not enough juice, as we call it, in the equity. All right. So again, I know I went through that quick. Any examples or scenarios, once you look at these a couple of times, it'll be second nature to you. So don't be overwhelmed by all those numbers. Let's go through a couple of a new construction loan frequently asked questions. Can I use this loan for land development? No, it's not meant for the big developers that are taking down huge tracts of land. Typically, those investors are going to go to the big money center banks or the regional banks to do those construction lending. I'm looking for investors that are typically being kicked to the curb by the money center banks, right? The ones that are building, 2 to 5, 6 to 10 properties a year. or investors that do fix and flip but like to see an opportunity to acquire a vacant lot and hire a GC and build on it. That's the type of investor we're looking for. I will make these loans directly to builders, or I will make these loans directly to investors that hire general contractors to do the build. So remember that. Go after builders, go after investors that like to build ground up and flip it or turn it into rental properties. What are the loan terms? We set these up for 12 months, just like we do the fix and flip. What types of properties? Same as the line of credit, up to 20-unit apartment buildings. Can the product be used to finance subdivisions? Typically not. We'll haircut it down to 5 at a time. How many draws can I take? It doesn't matter to us. They can have many draws or multiple draws. There is a draw fee. It's $145 because remember, the granite construction inspection report guy's got to get in his truck, go to the job site, write a completion report, and get it back to us. And for that, it's a $145 fee per draw. All right, that is new construction. Let's go to the next. We're going to jump into rental property financing. Rental properties, big difference here, and then let's take a big about face in terms of condition of property here. Remember, for the fix and flip and the new construction, I mean, a fix and flip, they could buy a house that's totally gutted and a big hole in the roof and no electrical or no plumbing, and that's fine because we're going to control the rehab of that. We're going to make sure that it meets within the after repaired value, and we can deal with distressed property. But the rental property is not that. The rental property, remember the term rent ready. These properties have to be rent ready. They have to be ready to put a tenant in place with no rehab financing. That's the way the product works. If they want to acquire a rental property loan and it's distressed, they have to go fix and flip first to do the acquisition and the rehab. And then once it's rent ready, they can refinance into the product that I'm going to go over right now, which is a 30-year fixed rate product for rent-ready property. No income tax return required, so no personal income required. No property count max. They can have 100 rental properties or mortgages on the loans on their properties. We'll lend up to 80% of the purchase price, and that's on a purchase. We'll lend 75% on a refinance transaction. This is a single property loan, and I'm going to go over blanket property loans. The difference is the single rental loan is a 30-year fixed product. The blanket portfolio loan is multiple properties under one loan that we cross collateralize or blanket into one loan size. Next slide. All right, lots of numbers here. It probably looks a little daunting on your screen right now, but I'll just go through it quickly. Let's start with the first column on the left. This is single rental loan. We'll do purchase or refinances, so every property will have a separate loan. So you can do 2 or 3 property loans off the single rental loan. Each property will have a separate loan. That's the single rental loan. Minimum loan size, $75,000. That's a hard stop. I cannot sell these loans at a loan size less than 75. And we tap out at 1.5 million for a project single property loan. It's not a line of credit, so there's that says NA there. What are the terms? It's a 30-year fixed, fully amortized. We do offer a 5-year interest only and then a 25-year full am. So that's for investors that are looking for maximum cash flow in the first 5 years. We have our LTVs, 80% on a purchase, 75% on a refi. Don't worry about the cash flow coverage. It's called property debt to income ratio that we run on our model. So my model, when you put in the property address, the gross rent, the annual taxes, annual insurance, it'll run the cash flow model for you. But for those of you that are, want to do the back end math yourself, we'll lend up to 85% of the property debt to income on the property if it's valued over 150, and we restrict that to 70% property debt to income properties less than 150, and then some other math on the interest only side of it. Individual or entities, so if the borrower wants to take title in an LLC, that's fine, we do that. And property types, pay attention to this one here. We cap at a 4-plex. So kind of on your conventional guides, that we have that guide, we're capped at a quad. So we will not do multifamily 5 or more units on the single rental loan. Prepay, it's called a declining 3-2-1, also known as a step down. If they pay off the loan in the first year, it's a 3% penalty. 2% penalty in the second year, 1% in the third. No penalty after 3 years. So they have to have at least a 3-year horizon for a hold strategy, which is typically not a pain point for the prepayment penalty. They plan to hold these more than 3 years. We do risk-based price on this product. We will not make a loan to an investor with a middle score less than 660. An interest-only option, we're looking for a higher score of 700. Okay, those are the guides, general guides on single rental loan. Let's shift over to portfolio. And portfolio, this is when you're working with seasoned investors that have stabilized portfolios. We don't see a lot of purchase transactions on this, although we may see more in the future as some of these investors start unloading stabilized portfolios. And they're looking for investors to come in and buy them in bulk from the seller. So we will do a purchase transaction on the portfolio, but remember, they have to close concurrently, all these properties together. And the only way to make that work is if it's one seller that is selling the multiple properties in a stabilized portfolio. Typically, you're going to see cash out refis on this. Minimum loan size, $700,000, which means you need an evaluation of all the properties over $1 million for the 75% LTV. We do not offer 30-year fix on this product. There's no investor demand for these blanket loans at a 30-year fix. So they are 5 or 10-year balloons. This is a fixed rate product for either 5-year term or 10-year term, but they do balloon after the term, which means the borrowers have to have an exit strategy of selling the portfolios and paying us off at the end of the term, or refinancing into current market rate and paying off the balloon when it comes due. Debt service coverage ratio, DSCR, has to be at least 1.15. And again, don't worry about that. Our pricing model will run this. And in fact, our portfolio rental loan is manually priced by one of my analysts in our headquarters in Charlotte, North Carolina. So you don't have the ability to run pricing on the portfolio. You just upload a rent roll, which is all of the properties and all the details of the inputs, rent, taxes, and insurance. And then my analysts will run the model and sell the loan product to you and your borrower over the phone. So they'll go over that with you, but that's manually priced. The single rental loan, you price that yourself. So within 5 minutes of inputting those numbers, you have a term sheet that you can share with your borrower that has the loan size the property qualifies for based on cash flow and the interest rate the property qualifies for. Back to portfolio, property types, all the way up to 20-unit apartment buildings. So we do go back up to the 20 units on the portfolio product. Prepay, it has yield maintenance, which basically means if you take a 5-year term and pay off the loan in 4 years, they still owe 5 years of interest. And that's a demand that our investors have that we sell these loans to. They don't want to get paid off early, so it has yield maintenance. The borrower can also choose declining points, which is if it's a 5-year loan, they can choose a declining 5, 4, 3, 2, 1, their option. And a minimum credit score also of 600. So that, in a nutshell, is our rental property loans, both portfolio blanket loans and single rental loans. So to summarize the 3 products that we went over right now, you as mortgage brokers do not have to leave any business on the table. If you work with investors, whether they're buy and hold investors, fix, flip, and buy, fix, and sell, whatever, we have permanent financing for the rental properties if they want to hold them, and we have short-term money for the acquisition, the rehab, or the new construction. All right, next slide, Ginger. All right, I'm not gonna go into these details. This is for those of you that are more analytical, but this is how you calculate property debt to income on the single rental loan and the DSCR, debt service coverage ratio, on the portfolio blanket loans. You'll have that in the slide to go back to. Let's jump to frequently asked questions on the rental property loans. Can a client close in the name of the LLC? Yes, 99% of our borrowers do. Do you offer, but they can choose to close individually if they want. Do you offer an interest-only option? Yes, we do on the both products. So that's an option. We find that investors that want to maximize their cash flow take the interest-only option. What are the key requirements for the portfolio? There's several of them. We need at least 7 doors. So we need 7 doors, meaning like if it's a duplex counts as 2 doors, fourplex is 4 doors. We need at least 7, and we need a minimum loan size of $700,000. The property value must be at least $50,000 in each of the properties. In certain markets, that's $100,000. So we'll typically in markets that have some demographic issues, either declining values or high crime areas, we might have $100,000 minimum property value in those areas. And multi-units will go down to $30,000 on a multi-valuation. But remember, we need a minimum loan size of $700,000 to fund these blanket loans. What if my client has a small portfolio and they want have less than 7 properties? That's no problem. They don't have to take the portfolio. They can do multiple single rental loans. And I have a lot of investors that prefer that. Why? Because they want a 30-year fixed right now. Pricing on the 30-year fixed is anywhere from 6.5 to 7.5. Although that's higher than conventional, we close those loans, and not all of our investors qualify for the conventional financing. So, if they can tap into a 6.5% 30-year fixed and raise rents for the next annually for the next 10 or 15 years, those properties are really going to cash flow strong. We also offer buy down options on our single rental loan all the way to 5.5% rate. So at closing, borrower can pay a buy down fee and get a 5.5% rate or 5 3/4 if they want to hold long term. I have a lot of investors that are exercising the buy down feature. And then finally, what types of properties qualify? The single rental loan taps at a quad, so no more than 4 units on the single, and we will go up to 20 units on the portfolio, just like we do the fix and flip line of credit. Next slide. All right, finally, we're in the home stretch, guys, almost done. How do you do business with FACO? There's 2 options. You can refer business to me or the field market specialists in your area, or you can broker the deals. If you refer, you basically send an email to the FACO representative, in this case me, introducing your client to me and letting your client know that we will take over from here. What I will do is make contact with your borrower. I'll sell the loan. I'll answer all the questions. I'll do all the system work in our system. I will be the liaison between my processor and underwriter and the borrower. And the short of it, I do all the work and we pay you a point every time the borrower closes a loan on the fix and flip or the single rental loan. That's a referral. The broker. As a broker, you remain customer facing. So you sell the loan, you do the system work, you upload all the conditions and chase the conditions, and you're involved start to finish in the process. For that, you have the ability to earn up to 200 bips, which is 2 points on every transaction. And you are customer facing, so you're the main contact with the customer. So that's something that you can discuss with your brokers. And we do quite a bit of both. I have a lot of investors, or I'm sorry, I have a lot of mortgage brokers that start out on the referral side to learn the business. And I set up 3-way phone calls with them so they can hear me sell the loan and answer the borrower's questions. I always loop them into the email. So every time a borrower has an email question, then we get that addressed, and they can learn from that side of the business and then transition over to a broker. But those are options we can always discuss later with your principal broker as well. All right, let's jump into where we lend. We lend in 45 states. There's 5 states we don't lend in. The Dakotas, Alaska, Utah, and Vermont. Some of these states require licensing, some do not. If they require licensing and you don't have the license, we can do it as a referral and use our licensing. But that's a pretty big list of states that we can lend in. Next. Sales and marketing tools. All right, we're going to be coming out with, we're going to be improving, we're constantly improving our products and our guidelines, but also we're improving our loan delivery system, so that'll be rolling out shortly. And we're always looking for ways to limit the amount of required documents that we have. So all of these things are coming down the pipe, which we can keep you updated on. Our guidelines are on our website. So when you have access to our website, you can pull down our guidelines and our product matrices. You can create your own white label marketing flyers for our fix and flip line of credit and new construction and rental property loans. And you can do the same thing with our, you can customize our deck. So you can go out and make realtor presentations with your contact information and logos on our decks. All right. Next steps. Schedule a branch training. So I do these all the time. And if you have, if we have principal brokers on the call right now that you want to set up a private showing, a private webinar, then we can do this for your team and have a lot of Q&A. Again, we don't have a lot of time for Q&A today, but we can do that with the individual presentations to your broker shops. And you can, I'm in Tampa, Florida. Of course, I run out, I fly a lot over on the East Coast and do trainings as well in your shop. So just schedule that with your field market specialist in your area. And again, this is very important. Underline, you do not have to be an expert right now. At one time, you started out in your conventional GovD business without knowing much other than taking a test and getting a license, but you have been successful doing that. The same thing on the commercial. Do not leave this business on the table. Other brokers will pick it up and close loans and get paid. You need to learn it, but you don't need to know everything today. Just enough to be dangerous. Everything I taught you on this is enough for you to go out and sell it today. And then, you know, you don't have all the answers, but you will get the answers. There's only 30 or 40 questions these investors are going to ask. Eventually, you're going to learn the answers, and the answers will roll off the tip of your tongue. And again, if you set up conference calls with me, you'll hear all the borrower's questions at once. You'll hear all of my answers, and then you'll know the answers the next time. Next. All right, Q&A. Ginger, I'll throw it back to you.
I will. And I tell you what, you guys have been awesome. Thanks for all the questions that are coming in. I am going to ask a couple of questions. I do want to let you know, because I'm getting a couple of you asking, is it being recorded? Yes, this webinar is being recorded. I will send out a follow-up email to you tomorrow, and it'll have a copy of the recording as well as a slide deck. And I'll also include information as far as getting started, because I think that's good to go back through that again. So thanks to all of you who are sending your messages as far as being a great webinar. It is a great webinar. But I'm going to ask a couple of questions, going back to one that came up pretty early. How long is the line of credit open for?
Yeah, 12 months.
Period.
So we'll commit to the exposure limit, the line of credit, for 12 months, which gives them 12 months to tap into the line of credit for project loans. Don't confuse the term of each project loan, because that's also 12 months, right? So once they tap into the line of credit, we give them 12 months to repay that individual project loan. So they'll have multiple project loans by tapping into the line of credit, each one with a different expiration date on their repayment term. Now, let's say they have a line of credit set up and they tap into the line of credit month 10. We're still going to honor those terms. We're still going to give them 12 months to repay that loan. But after 12 months for the line of credit, if the line of credit is aged more than 12 months, we need to refresh it. And we refresh it by running credit on the borrowers, getting their liquidity, updated liquidity, and their updated track record experience. And then we reprice it for another 12 months. That's
perfect. Question, can you get a non-branded price quote sheet to send to borrowers?
Right now, no, but we're working on that. Remember, one of my last slides was the new and improved wholesale lending platform 2.0. We're still in 1.0 today, and we're going to be rolling out 2.0 in the next month or so. So we're going to have much more enhancements for the white label project. We understand that. You want to have all your customer information, or your your broker information and contact information on those forms. But currently, when you send out a term sheet, it's going to have Finance of America Commercial on it.
Very good. So on the referral program, the question is, will you pay individuals or the broker owner? And, you know, in wholesale, the money goes to the broker and the broker pays the LO.
Sure.
So how does that work? Is the individual
Right.
LO play? Do they need to split it with the broker for the
They have to split
referral
it with the
program?
broker. Yeah, they have to. If we have the broker shop approved and set up with Finance of America Commercial, then we're gonna, on the referral, if their individual MLOs refer, we're gonna pay the broker shop, and they're gonna do their own splits.
And remember, this is and follow through on this, John. I'll let you. But the question is, because in wholesale we have a broker comp agreement with FAM, and so they need to set up a separate agreement with the commercial division, which is not going to be tied, because if they have a broker agreement with FAM and they're getting paid 2 points on that broker agreement, then it's a completely separate agreement from what they have with wholesale.
I understand. Remember, we don't get involved or have those limitations or require that you guys remain consistent on the commercial side with compensation. It's just that's outside of the regulatory environment we're in. So what I'm telling you is, each individual MO, let's say I'm talking to a principal mortgage broker right now that has a shop of 10 MLOs. Each MLO can, you can decide how much you pay each MLO. Maybe you form your own tiers, and it could be every borrower's different. Maybe you do it. Yeah, what I'm saying is, it doesn't matter to me, and you don't have to tell us what your tiers are. I'm going to send the broker a check on every funded loan, and they do the split however they choose to.
Yeah, there's different under LO comp, and guys, just so you understand, because we live in the world of regulations, so under LO comp, because this is a commercial, non-owner occupied, the same LO comp rules that we're so used to on our primary residence and second home, they're gone. So that's gone. So so we are at the hour, and I tell you what, the comments are great. Awesome information. John, thank you so much. I always love listening to you. I think this product is absolutely phenomenal. So make sure and get the follow-up information tomorrow. Talk to your FAM account executive, because they can help you get started on this program. And remember to get registered for our upcoming webinars that are happening. You can find those at www.famuevents.com. So you guys, thanks so much for attending. John, thank you so much for the information. And look for more commercial webinars coming out sometime in the near future. So thanks so much, guys.
All right. Thank you, everybody. And go out and ask for the business, and you'll get it.
I love it. Thanks.
All right. Bye.